The price of gold has soared to a new record, topping $5,000 an ounce for the first time. Investors have been looking for a safe haven amid global uncertainty. Fears of a renewed trade war, inflation, and the potential for another US government shutdown have all been fueling gold's record run.
News with precious metal prices dropping at rates not seen in decades, with silver plunging 30% over the weekend and gold dropping sharply after months and months of higher prices.
The price of gold has risen above $5,000 an ounce for the very first time, extending a historic rally that saw the price jump by more than 60% last year. Gold and other precious metals are seen as so-called safe haven assets that investors buy in times of uncertainty.
Let's dive in. Before we talk about the actual price crashes, let's set the scene and explain why this matters. You've probably heard that gold and silver are often called safe haven assets. That means when investors get worried about the economy, inflation, or political risk, they tend to buy gold and silver because those metals usually hold value better than stocks or cash. For years now, both gold and silver had been rising, smashing through all-time price records. People were buying them not just as jewelry or industrial metals, but as financial insurance. Then came the news that changed everything. On January 30, 2026, President Donald Trump announced that he was nominating Kevin Warsh to be the next chair of the Federal Reserve. That's the Central Bank of the United States, replacing Jerome Powell. This is a huge deal. The Fed chair influences interest rates, inflation expectations, and basically how easy or hard money is to borrow. Now here's the twist. Most traders and investors had been betting that Trump would choose someone who would be very dovish on interest rates, meaning someone willing to cut rates aggressively or weaken the dollar to push the economy forward. This belief helped fuel gold and silver's rally. If the dollar gets weaker, gold and silver become more attractive because those metals are priced in dollars, and a weaker dollar means foreign investors can buy more of them. But when Trump picked Kevin Warsh, markets suddenly changed their minds. They realized Warsh isn't seen as a dove. In fact, he's considered more hawkish, someone who might focus on fighting inflation and supporting a stronger US dollar. The short answer is this: when investors started to believe that the Fed might be less aggressive about cutting rates and that the US dollar might stay strong or get stronger, gold and silver suddenly lost some of their shine. Here's how that works. Gold and silver don't pay interest. You don't earn dividends or yield just by holding them. So when interest rates go up, people tend to move money out of metals and into bonds or interest-bearing assets. And prices on gold and silver tend to fall. It's a simple trade-off. If you can earn interest in other assets, metals become less attractive. At the same time, the US dollar started strengthening. When the dollar goes up compared to other currencies, metals like gold and silver become more expensive for people holding foreign currencies. That also reduces demand. So right after the Warsh nomination, news hit markets. Gold dropped dramatically from its record highs. Silver plunged even harder, with one of the worst single-day losses since 1980. And traders around the world began selling to lock in profits and avoid further losses. Now let's talk about how this played out across financial markets. Stock markets were also affected. Major indexes like the S&P 500 and Nasdaq saw dips as nervous investors reassessed risk. Commodities markets felt the shock too. Metals like platinum and industrial metals also moved down with gold and silver. Even Bitcoin experienced volatility as part of this broader risk-off environment. But it's important to understand this wasn't just panic selling. A big factor was profit-taking. Many investors had been holding gold and silver for a long time, and with all-time highs recently hit, some started to take profits, selling what they bought earlier to lock in gains. That selling pressure, combined with stronger dollar expectations, created a feedback loop of falling prices and more selling. Here's another thing to consider. This shift in sentiment didn't happen in a vacuum. The narrative around the Fed and inflation expectations had dominated markets for a long time. Many traders thought the next Fed chair would be someone who might cut rates quickly, weakening the dollar and boosting precious metals. When Warsh's name came out, someone perceived as more independent and less likely to push aggressive dovish policy, markets were forced to reprice everything almost instantly. It's worth noting that this didn't erase all the gains metals had made over the past year. Even after the plunge, gold and silver were still elevated compared to where they were a year ago. But the sudden drop was dramatic enough to shake confidence and create headlines worldwide. Imagine you're holding gold at nearly $5,600 per ounce. That's a record high. You've made significant money as prices climbed. Then news hits that the person likely to lead the Federal Reserve might prevent aggressive rate cuts. Instantly, the dollar gets stronger. You start worrying that gold may not go higher in the near future, so you sell. Multiply that behavior by thousands of traders around the world, and you'll see how prices can fall very fast. So what does this mean going forward? Some analysts are saying this could be temporary, that markets may calm down once investors get time to digest the news and adjust their expectations. Others say it's a real shift in sentiment and that precious metals may go through a period of correction or volatility before finding a new direction. Let's think about it from a broader perspective. A strong dollar, controlled inflation, and the expectation of stable interest rates tend to pull money out of metals and push it toward other investments like stocks and bonds. But metals can still act as long-term hedges against inflation, geopolitical instability, or financial crisis. So the long-term story isn't necessarily broken, it's just changing. Now let's address what many investors and viewers might be wondering. Is this the end for gold and silver? Absolutely not. Even with sharp drops, prices remain much higher than they were a year ago. Sharp swings are actually part of trading realities in global markets. What we're seeing now could be part of a normal correction after a long rally. And another important point, a stronger dollar doesn't always last forever. If economic conditions change, inflation picks up again, or geopolitical tensions rise, gold and silver could regain upward momentum.